And one of the reasons we're doing so well, both online, we have great orders and people coming in the store, is we got better prices on a whole lot of stuff than everybody else does. I'm going to start with Silver Eagles. I've got these priced about, by my count, $5 to $6 cheaper than the major online retailers. You can get it in the store or online for just over 30 bucks. It's hovering, depending on the spot price, between 30.5 and 31.5. Most places are selling for $35 to $38. American Silver Eagles, these are beautiful that we have had in storage for a very long time. We're now bringing them out for the store, plus we'll be ordering some new ones. This has been our single bestseller online because people are starting to figure out we have better prices than anyone. This is a killer deal, guys. If you want American Silver Eagles shiny in really good shape, random year, any year, you order them through Gold Silver Pros. I'm almost guarantee you we'll beat all the major retailers or most of the major online retailers on these products. I also have the beautiful and the gorgeous maple leaf. It is my all-time favorite silver and gold coin. I just love the relief and I love the shine of this coin. We have these for about $2 to $3 cheaper than most online major retailers. You can come in the store and pay no shipping or pay a very modest, very small shipping charge for getting these in. We ship through the Postal Service for anything under $2,000. So your shipping charge is usually only about 10, 11, 12 bucks, depending on how many you order. But given the price discount we have on these, it's really cheap. And for a short time, if you order more than $1,000, I'll waive your shipping. Just contact me if you're going to do that, and I'll show you how to get a coupon code for the store. But you can only get that by contacting me ahead of time if you're ordering online.
Welcome to Gold Silver Pros.
Everybody, this is your host, Rob Kientz of GoldSilverPros.com. This is your weekly market wrap special holiday week edition. We're broadcasting on Tuesday, September 5th, 2023, about 4 p.m. Central Time in the afternoon. Thanks, everybody, for sticking with the channel as we get through the Labor Day weekend. Hope you guys had a great Labor Day weekend, and you're as excited about the week as I am, because I think we may be getting closer to gold and silver taking a moonshot. I know it doesn't look like that on the charts, but I'm going to go over why I think that's potentially the case as we get into the data. We're going to start with the macro view and go over the data that we're seeing. Last week, we received a lot of data, and that's because it's the first week of the month, and so we tend to get the employment reports and a lot of other interesting data. For example, let's break it down for you what the economic reports mean, especially the labor reports. As far as I'm concerned, the employment numbers are not reliable at this point. Despite ADP revising their entire jobs model earlier this year based upon the government's non-form report from the BLS, their numbers continue to diverge away from each other. Put plainly, even though ADP bowed to the U.S. government and copied their methodology, they still get a much different number than the BLS does, and it gets wider every month. Anyone who continues to believe that the government report is reporting honestly must be living on a different planet. There's no credibility left in that report whatsoever. Let's break it down. We see that the BLS number was up to 187,000 jobs created, about 30,000 more than the previous month. At the same time, it was also reported that the BLS changed their methodology and their calculation again, which downward revised their job numbers, not only for the current month, but for the past year, meaning the amount of job gains that have been reported for the past year from the BLS was severely overstated. This is after the BLS previously in January of this year had made a different methodology change, which revised all of their previous calculations upward. Those guys cannot make up their mind what the story is that they want to tell. And I think that there's zero credibility whatsoever on the jobs report numbers from the Bureau of Labor Statistics. I challenge anybody to correct me on that and show me where it is a credible number. I don't think anybody's going to be able to do that. The ADP private payrolls report reported a different story altogether. They had a significant drop in job creation from this 371,000 jobs created last month to only 177,000 this month, a change of almost negative 200,000 jobs, which feels more realistic as I look at the economy than what the BLS is saying. The rest of the economic data isn't wonderful either. Job openings fell almost 500,000 this month. GDP fell 0.3%, which makes more sense in a declining labor environment than in an expanding one. Retail and wholesale inventories both fell, which falls in line with the declining purchasing manager expectations that we reported on the last time, and the fall in durable goods orders that we reported on last time. Both producers and consumers are buying less stuff, indicative of a flagging national economy, not a growing one. And don't look now, the core inflation index the Fed counts on for policy decisions is now rising again. That's right, we may be headed back into second wave inflation, as I've been reporting on for the last few months. The PCE index is up almost 0.3% month over month, and the core PCE index is up 0.1%. And it may not sound like much, but when prices rise as production and jobs are falling at the same time, it means rising prices are not demand driven. It's the increased monetary supply, which is bidding up the prices of goods in the face of a falling economy. Oh, and by the way, wages fell 0.2%, meaning your paycheck will buy less than it did before. Manufacturing and construction were both up very slightly on the month, but those are minor parts of the economy when compared with services and the rest of the economy. And honestly, without those very slight gains in manufacturing and construction, the whole economic print would have just been worse. Now on to the stories of the month, and then I'll tell you about what the markets are doing. The major story of the past week and of the past month have been the labor strikes popping up across the world. I'll report on two of them and mention a couple of others, but there are more going on right now. It's like raging wildfires in the employment market as unions and employees step up and protest their wages. Previously, we had reported on both Yellow and UPS and the results of those. Yellow has now gone under 30,000 jobs lost. UPS has raised wages to 170,000, which I think UPS means probably on its way out because I don't think they can afford to pay their drivers that much. The trend on striking workers demanding higher pay is starting to become obvious, and it stems ultimately from inflation having whittled employee purchasing power so far that people simply cannot make ends meet anymore. The first story comes from Australia, where Chevron liquefied natural gas workers have threatened to strike starting September 14th, only about a week and a half away, over pay and working conditions. The announcement from union in particular is brutal, as it threatens to cause billions in losses to the company. Per their Facebook post, let me read to you that post. A quote from that post: "The Offshore Alliance is escalating protected industrial action to demonstrate that our bargaining negotiations are far from intractable," Offshore Alliance wrote in a Facebook post. The union continued, "Offshore Alliance members are yet to exercise their lawful workplace rights to take protected industrial action, and our bargaining claims will look more and more reasonable as Chevron's Gorgon and Wheatstone LNG exports dry up. The Offshore Alliance log of claims will ultimately be claims which Chevron will agree to, but not before they lose a few $billion, judging by the form guide." In other words, these are the guys that run the operations for the company. They know that they can bring Chevron to its knees by forcing them to lose billions, and Chevron's going to have to go to the table and negotiate higher wages and better pay and better conditions. That union, ladies and gentlemen, is not messing around, and not to be outdone by the shipping unions that we reported on earlier with Yellow and UPS. The Northeastern Rail Union plans to strike in 2024 over wage demands. They would strike now, but there's a cool down period as part of the previous negotiation, but they can plan for the strike next year. The walkouts and strikes threaten to derail, pun intended, thousands of people in New York, Philadelphia, and New Jersey areas that need to get to work and need to commute. Among the complaints, the rail workers noted their efforts during the pandemic, keeping the trains running during a major health crisis without ever seeing a wage increase for their efforts. Per the Politico story where we got this, here's a quote: "There has not been a substantial enough recognition of what happened during COVID," said John Samuelson, the International President of Transportation Workers of America, which represents 140,000 transportation workers across the country. This is a huge union, ladies and gentlemen, and they've got lots of bargaining power. These new strikes, according to Politico, come on the heels of a summer of strikes, including Hollywood actors and writers, nurses and doctors, professors in the same Northeast region, along with threats from New York City school bus drivers. And so many groups are threatening strikes at the same time, it's easy to see the ability of wages to keep up with the latest round of inflation and how it's affected people across the world. As we said during the last bout of inflation, it would have effects and they would come home to roost. And now we're seeing union strikes across the world. And now what's happened? We got through a mini deflation period, and inflation has started to tick up again this month. That's going to exacerbate the amount of unions and the amount of workers that are going to complain and sue for higher wages. And mark my words, we're at the very beginning of what will be a nasty and protracted period of inflation stemming from the massive amount of money printed during 2020, the pandemic, and subsequent actions by the Fed, along with their current tightening. It's going to get worse before it gets better. Moving on to the economy, we're looking at the stock market. Headline on CNBC is that the Dow closes 200 points lower as rising oil prices drag down stocks. What's happening with oil? Well, OPEC and Russia basically are cutting a little bit of production, forcing higher oil prices as they believe they had too much supply. That's causing a little bit of rise in the oil markets. Overall, all the markets in the U.S. are red, and the VIX, the volatility indicator, is up to 1401. Not in crisis level, but definitely rising 1.37% today. The volatility index, the Dow has fallen 0.56%. The S&P 500 has fallen 0.42%. NASDAQ has fallen only a modest 0.08%. And the Russell 2000 index, the small cap stocks have fallen over 2% as they're getting hit the worst. The cryptocurrencies are basically in a bloodbath as well. As we look at Bitcoin, it's down 198 points today at 25,677. It has not recovered from when it fell from 30,000, and it didn't recover when it fell from 60,000. Bitcoin's just not doing well right now. So we look at Ethereum, it's down $2.34 to 1627.42. Litecoin is down 71 cents to 62.94. And the rest of the whole cryptocurrency complex is taking a bath today. Bonds, interestingly, are not taking it quite as bad. The 2-year has fallen under 5%. That's right. It's at 4.96 after briefly going over 5% last week. I reported on that on the last weekly market wrap up. Everything shorter than the 2-year, though, is solidly above 5%. The highest, again, being 6-month, which is your indicator of when the recession is going to happen, is trading at 5.529%. And the yield curve is still inverted, meaning the 2-year is trading at a higher rate than the 10. The 10-year benchmark is trading at 4.266%. The 2-year is about 0.7 points higher than that, indicating an oncoming U.S. recession. We've given you the stories of the week, the economic data. Let's get into the precious metals part of the presentation. Ladies and gentlemen, here we are at Gold Charts R Us looking at gold. As you can see right here, we're above the 250-day moving averages, meaning short-term gold is better than its basically 2-month and 6-month trends. However, you can see the overall gold trend is down since May, but since the beginning of summer, it's been even. So overall, I think that we're doing pretty well in gold, not perfectly, but okay. It's held serve over the summer, which I think is a bullish sign. It took the best shot the markets had on reducing price this past 6-7 months, and it's recovered nicely. Silver's a little bit different. It's up on the screen right now. You can see it also above the 250-day moving average. It's recovered from the last couple of weeks where it had a little bit of a mini swoon as we approach the end of summer. It's back above it, but you see a declining wedge here. As you can see, if I draw a line from the previous top to here, it's declining. And then if I draw a line here, it's a wedge. And it is a bit of a declining wedge overall, but the trend for the last 50 and 200 days is actually up, especially the last 50 days is up. So even though we're in a declining wedge in the silver market, the last 50 days is positive. Going to the volume and open interest on the CME Group's website for the gold market, we can see, again, trade has not been very strong this summer for gold. That's normal. So we're dealing with prices holding steady on a weak volume. What happens when the volume returns in the fall? Will it mean gold goes into a swoon because people want to short, or will it mean gold goes into a bull market because they want to bid it up? We'll see what happens. As you can see here, contracts are already moving off of December into the next few months, beginning the year, but December is still the dominant month at 378,000 open interest contracts. On the data that we have so far on Friday, we had at close 378,000 contracts, 160,000 volume on Friday, which is a lot. It's over a third of the total volume. We had 1,166 contracts move over to London to see if they can get exposure to the unallocated market over there. We had 681 deliveries. That's Friday's data. What happened on Thursday? We had a lot more EFPs on Thursday, 4,700 contracts, no deliveries on the August contract, and we had 133,000 contracts trading. So pretty robust in terms of trade. If we go to settlements where we get the price data, this is actually as of today, as of 1:32, we got about a midday print here. The dominant contract month is still December. You see all the numbers there. We did have some volume there, estimated volume on the October contract, 6,200, but the vast majority, 181,000 contracts so far trading today, have gold trading down 1450. That's right, down 1450. And if we go back to previous periods, on settlements, that was today's data. If we go back to Friday's data, gold traded up $1.20 on the December contract, and on Thursday it traded down $7. So again, it's back and forth, up and down, no specific movement. However, in the retail market, as we look at the GLD ETF, this is where a lot of retailers get exposure, we can see over the last 3 days, the last few days of August, we have positive flows into gold. So the retail market is starting to come back a little bit into GLD, which is a positive sign as we head back into the fall, because retail trades what's going to bid that price up for gold and silver. That's a positive sign. It's a little bit different in silver. We'll get to that in a moment. Looking at the volume and open interest on silver, a lot more trade, relatively speaking, on silver than in gold. And the dominant month is, again, December. That's where you see the big numbers. A little bit of trade here in October, but not much. And we see on Friday's data, 61,000 contracts traded, only 288 deliveries on the September contract. EFP's 575, pretty muted. If we go to Thursday's data, much like gold, we have more EFP, 770 contracts of 5,000 ounce gold, 47,000 contracts basically closed last Thursday. If we go over to settlements, we're looking again a half a day of today's data, Tuesday, September 5th. You can see up here where I'm waggling the mouse. On the trading data, we get it not quite real time, but we don't get it a complete day in arrears. So far today, silver is down 69 cents on the December contract. A little bit of trade on October, down 67 cents, sorry, not much. If we go back to Friday, we see silver traded down about 25 cents on the December contract on the strength of a volume of 61,000 contracts overall. And we'll look at Thursday to give another day's view to see what happened to end the week. It was down. So silver was down the majority of last week, but look at what's happening to silver. It has continued in the retail side of the market on SLV to see outflows. Right now, silver is weaker than gold. That's because it follows gold, and gold's popping up a little bit. Silver may come later. We'll see whether gold has an extended run up. We don't know. Looking at the Shanghai market, ladies and gentlemen, for last month, the report is out. We had 73% of gold contracts for the month deliver. I'm sorry, this present month, 72.58%. 73% year-to-date of gold has been physical delivery. That's much different than the charts I just showed you for gold and silver here, where the deliveries have been muted. For example, in the December contract, the most recent trading day, we had 61,000 contracts trade and only 288 deliveries. That's a very minute percentage. Over in Shanghai, they're having 72% of gold and 16.55% of silver delivering on the month. And what I really wanted to show you was the cash settlement. This is a difference in price between the gold in Shanghai and the gold on the American market. It's up to 60 bucks. Usually when I'm looking at this on gold, it's $43. Now it's up to 60 bucks. Gold is trading higher and higher around the world, especially in Shanghai, than it is in the US market. I think that's an indication of where the world wants gold to go. It wants it to go up, not down. And you can see that in the Shanghai, there's a spread. So if you're taking your gold and silver from the US over to Shanghai, you would make $59 per ounce on a contract if you can do that, sell contracts in the US and buy contracts in Shanghai. But it means the physical price is more than likely to go up. Looking at London Vault data, not a big change. We do have the July number here, July numbers here. They're really, we should be getting August any day now. Gold is slightly up and silver is slightly up in terms of what they're reporting on the unallocated market. That's just stocks more than anything. And again, that's unallocated, so it's not really guaranteed to be a full representation of that market or of the liquid availability in that market. But I report the numbers to show the overall trend. And it does mimic sort of what goes on in SLV and GLD, because that's where they store most of the gold and silver for those retail funds. So we like to talk about it. So to some, economic data not looking good. Inflation has started to tick up. The inflation bout that we had before and the tightening by the Fed has led to a tightening in the economy, job layoffs, a record number of corporate bankruptcies this year. Wages are stagnating relative to inflation. That's led to workers striking. You're starting to see it around the world, not just in the US, but all over the place. It's led to some unrest. I think that, along with the weakening economic data that I report on every week, is going to spur higher gold and silver prices. Gold and silver so far haven't really reacted, although they held serve in the summer. There's a little bit of fade from the May prices, but over the summer they did pretty well. The way I look at that is the gold and silver price wanted to fall this year after the spike up, after the bank failures in the spring. But the summer months, they held serve when they normally would have fallen. Gold usually somewhere between 8 to 10%. It stayed steady, which I think is portending or predicting higher gold and silver prices in the fall. And I think that's what we're going to see as the inflation data comes out, as we can continue to see problems with banks and corporates going bankrupt or having severe issues, as the Fed continues to waffle on whether they're going to tighten or not, and as the economic data starts to weaken. I think the jobs data is substantially worse than what's being reported by the government, and that's a farcical number that we see now from the government, but we'll continue to follow it because that's the official print, but we'll also follow other data points to help you see what's going on in the economy. That is going to do it for your weekly market wrap-up. This is Rob Kientz, your host with 𝑔oldsilverpros.com. Now we're doing the weekly market wrap-up on Tuesday. That means the live stream that we normally do on Tuesday will be on Wednesday. And because I'm broadcasting from the store where I'm at right now in my new makeshift set until I get the full one built here at the store, we'll be doing the live streams in the evening. Normally it'd be Tuesday evening at 6 to 6:30 p.m. Look for it at that time. But because we're in a holiday week and we're doing the weekly market wrap-up today on Tuesday, we'll have the live tomorrow on Wednesday, and then we'll do our normal data research report on Thursday as well. So you get 3 straight reports this week, whereas we would have skipped Wednesday. Thank you so much for joining. This has been your host, Rob Kientz of 𝑔oldsilverpros.com.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.